Good morning and welcome to Zicklin Talks Business. I'm Bruce Weber, the William Quaker Dean of the Zicklin School of Business, and I'm delighted to have you with us for today's conversation on a topic that sits at the intersection of finance, strategy, law, and resilience. That is, investing in distressed securities and bankruptcy situations. Most investors spend their time searching for strong companies with clear prospects. Distressed investors do the opposite. They look at firms under pressure, companies facing operational setbacks, liquidity shortfalls, or even on the brink of bankruptcy, and ask a different set of questions. Is there value that others are overlooking? What assets are mispriced? What can be rebuilt here? It's part of the market that demands discipline, skepticism, and a deep understanding of capital structures. And it reminds us that adversity in business doesn't necessarily signal an ending. Sometimes it marks the beginning of an opportunity. Today, we'll explore how investors evaluate troubled firms, how they separate temporary dislocation from permanent decline, and how returns can be generated even when headlines suggest the worst. We'll look at the legal frameworks that shape restructuring and the strategic decisions that determine whether a company emerges stronger or disappears altogether. To guide us through this complex terrain, Larry Zicklin, Baruch class of 1957, will lead a conversation with two experts who bring both practical experience and academic insight. Dov Gertzulin, Zicklin class of 2001, is managing principal of DG Capital Management, where he's built a distinguished career in distressed and special situations investing. His work exemplifies that analytical rigor and contrarian thinking can define this field. William Organek, assistant professor in our Department of Law, brings deep expertise in bankruptcy, restructuring, and the legal architecture that governs corporate distress. His research helps illuminate how law and finance intersect when companies face their most difficult moments. Together, they'll help us understand how opportunity emerges from uncertainty and what it takes to navigate one of the most challenging corners of the financial markets. We'll reserve time near the end for audience questions, so please submit those through Zoom's chat feature to my colleague on this webinar, Associate Dean Gwen Webb. Larry, the conversation is yours.
Thank you very much, Bruce. And I liked your word contrary. It's very difficult to be contrary when the headlines are screaming something else. Anyway, I first want to make full disclosure that I'm not only an old friend of Dov's, but I also am an original investor, I think, Dov. Is that correct? When you started the fund, how many years ago?
That is correct. In mid 2007, right at the peak.
That was very auspicious timing in your case. Dov, let me start with you. How did you get into this business? When you used to work at Neuberger Berman, you were an analyst, portfolio manager. It wasn't bankruptcy. What got you started?
Sure. So my history always has been being a value investor. Classic Graham and Dodd value investor, and trying to uncover value, trying to look in places that perhaps other investors are overlooking to generate excess returns on a risk-adjusted basis. And at Neuberger, I really gravitated to some of those I would call special situations, like companies perhaps that were having a tough time but could turn around earnings, maybe a one-time problem, or a spin-off transaction, or sometimes companies emerging from bankruptcy. And as I started learning more about that, and I was at NYU getting my MBA and started to take a number of courses on bankruptcy law, bankruptcy investing, distressed investing, restructurings, how that all works. I realized there's this part of the capital markets that for a very long time has really been dominated by a few specialists, which you could uncover tremendous value for a lot of the reasons I think we could imagine. A company is distressed. The company is, there's terrible headlines. And what I realized is, first of all, you could look at the entire capital structure of a company, and we'll get into that. And the senior debt has to be paid off before the junior debt, and the equity, gets wiped out and generally if they don't. So if the senior debt is not paid off, so there was a lot of opportunity and perhaps a greater margin of safety to earn a return in a in that environment.
But
And
you
for
never went to NYU specifically for that
I
because
didn't.
it was just chance.
It was just chance. It was complete chance. And I took some great courses with some well-known practitioners, and that really got me excited about it. So after a couple of years, I left Neuberger to start a fund that would focus primarily on those types of opportunities.
And Billy, why your interest in bankruptcy, distress, mass torts? You're muted, Billy.
There we go. It wasn't letting me unmute.
Okay.
Apologies. Yeah, thanks, Larry and everyone for being here. So my interest in bankruptcy law, so somewhat similar to Dov, actually. I was in law school and I was pretty focused on real estate was kind of my originally intended field of practice or area of interest. And I took one bankruptcy course kind of on a lark and really enjoyed it. And so I took every bankruptcy course that I could in law school. And eventually I clerked for a bankruptcy judge here in the Southern District of New York. And then I went on to practice. I practiced a little bit of bankruptcy and a little bit of real estate in my professional practice. But when I decided to transition from practicing law to go to academia, bankruptcy had a lot more, in my opinion, interesting issues, interesting legal questions, depending on the nature of the case, perhaps even some moral questions. So it really raised a bunch of interesting topics that I was excited to talk about.
Great, great. Dov, you don't practice your skill in the entire bankruptcy market. You limit it, I think, by size. Is that true?
We typically focus on the smaller, less, well-known bankruptcies. So typically, this may sound large, but maybe $2 or $3 billion or less. We're typically not playing in these mega bankruptcies where there's a huge amount of, massive dollars looking at that.
And I would assume in those smaller bankruptcies, you have more influence on the ultimate settlement.
Absolutely, we do.
Okay. And how big is this distressed universe today, or the bankruptcy universe?
Yeah, there are hundreds of companies. I mean, that they're tracked by various services. There's typically over 100 sizable investable bankruptcies per year, and you can track them. There's various services that will provide that information. And in addition to that, there's many more out of court restructurings or other distressed opportunities of companies that don't actually go bankrupt. And, I would call that like distressed debt or special situations.
And is that how bankruptcies come to your attention? Is it through the services? Is it stuff you read in the newspaper? How do you learn about these
It's really
activities?
it's really a combination of, as you could imagine, it's a combination of. I think you taught a class at NYU. I was in your class at NYU many years ago, and I hope it's okay to say that at the Baruch seminar, but basically, it's everything from reading the newspaper, as we used to discuss. I think Michael Price was in your class, who was a leading bankruptcy practitioner, and he used to talk about how to read the newspaper, and we would. So everything from reading the newspaper to reading about companies that are going through a hard time. And we of course don't want, we'll get into that, but we don't want to invest in any company just because it's having a problem. I mean, most of those companies are probably bad investments, to specialized services which cover the bankruptcy and distressed universe.
And is there a uniform or recognized definition of what the word distressed means? Is there a technical definition?
There is. I mean, Billy may want to weigh in on this as well, but the general definition is a bond that yields 1,000 basis points or 10% more than its reference, than its like investment grade or treasury or risk-free type of security. With that said, I think there could be there could be a first lien piece of debt that perhaps yields 10% and it should be yielding maybe 5%, but because the company is distressed, but it may present, have low risk, it may not have the return characteristic, but we'll still call it distressed debt.
Bill, do you agree with that, or do you have
Yeah,
a
I mean,
different
I think there,
definition?
so there's kind of the, I guess the finance look at it and then perhaps the legal look at it. And so, under the bankruptcy code, I think the typical test would be, a company that's unable to pay their debts as they become due, or perhaps a company that is, considered to be, say, balance sheet insolvent, right? That their liabilities kind of exceed their assets on a balance sheet basis. But I don't think that the bankruptcy code doesn't typically look to say the price or the yields at which debts are trading. But I think that's a really instructive way of looking at it as well.
And Dov, is your entry point when you decide to participate in a distress investment or a bankruptcy, is it always a debt instrument or is it occasionally equity?
We really look at the entire capital structure, everything from the first lien debt to the unsecured bonds to the equity, and see where's the greatest value. And sometimes it could be going long the senior debt and short perhaps a junior piece of the capital structure, where our view is the senior debt offers excellent value, and if and the junior debt or equity is vastly overpriced. At other times, it could actually be the reverse. So we take a holistic view to the capital structure, and it could be any part of the capital structure, and sometimes multiple parts.
So in effect, you could be hedging your position.
Absolutely. Absolutely.
Got it. And Billy, since there are two main chapters of the bankruptcy code, chapters 7 and 11, can you describe the differences between the two?
Yeah, sure. So, as Larry mentioned, right, there are kind of two main chapters in the bankruptcy code. There are actually a number of others, but the important ones for kind of our purposes would be chapter 7, which is a liquidation. So that's when a company is, really kind of at the end of its life, you could say. And so really it's going to be managed by a court-appointed trustee whose job it is to liquidate the assets, wind down the company, and obtain the most value that it can for the creditors, who ultimately at this point are considered to be the residual owners of the company. So that's chapter 7. That's really kind of the end of the life cycle. Then there's something called chapter 11, and that's perhaps the more interesting chapter. And that's when a company is perhaps not at the end of the life cycle, but perhaps really at an inflection point. And you can kind of say, the company is not it's not that the company is going to die. It's not that the company is really done, but it's perhaps they've taken on too much debt. Perhaps they've made some bad long-term bets. They need to right size, you might consider it. And so Chapter 11 gives a company the tools to restructure their liabilities, kind of rationalize their costs, and ultimately, hopefully, come out the other side as a stronger, more sustainable company. One way to perhaps think about it would be, and this is sometimes used in the academic literature, as the difference between economic distress, you're selling buggy whips and floppy disks and you no longer are needed in the economy, versus financial distress, you have perhaps made some bad long-term bets, but you still have a viable company, and so it's something that, with the right type of management changes, you could come out the other side more resilient and more interesting to the market.
So, Dov, in your investment process, you have to differentiate between a temporary dislocation and a permanent decline. How do you do that?
If that's, bankruptcy investing, the famous saying about it is fire and brimstone. Like you're really putting yourself out there and wading into some treacherous waters potentially. And what we look to do is what you've and Billy highlighted is trying to find a relatively good company with a one-time problem. So how do we do that? Well, I think there are some which could be fairly obvious, and we try to stick to those. So, for example, a company which has too much debt, but has a relatively good underlying business. There are good examples of that. And in fact, some of them could turn into leading companies. So a company perhaps, a good example is perhaps the wildfires in California. Depending how um, common that an investor will determine it will be, is this that, for example, the most recent wildfire was the most destructive in history. Are there going to be the most destructive in history wildfires again and again? Probably not, given that the most expensive real estate, or some of the most expensive real estate in California, already burned down. It could only burn down so many times. That's not to make light of it. It's a huge tragedy, but what I'm trying to say is that's probably a good opportunity to look at distressed investments that relate to that. Other types of opportunities would be, for example, a company that took on too much debt at the wrong time of an economic cycle, or there's a very unusual weakness in commodity prices for a commodity-oriented business, where if they had less debt, they would have been fine and able to survive on the other side. There could be one-time legal liabilities. So what we try to do is think about all these different things that happen to companies and say, is this a business that continues, or is this like the proverbial buggy whip company that just, it doesn't matter how many times you restructure it, a bad business that doesn't have a reason to exist will always, there's the saying, chapter 11, chapter 22, chapter 33, chapter 4. I think there's may have been one chapter 55, which what that means for people who don't know bankruptcy jargon, it just means a company that files again and again and again. At some point, you have to put it out of its misery and it just liquidates. But our goal is to find the relatively good businesses, and that's by understanding the business, the research that you would do as an investor, researching the business, speaking to experts, perhaps talking to management, understanding the history, understanding the future. I mean, that's the business really we're in, researching and understanding the company.
And so, as you've said to me on many occasions in the past, what I really want is a good business with a very bad balance sheet, because I can fix the balance sheet.
Absolutely.
But the good business is required.
A good business is required. I mean, if I can, like a great recent example of that. I mean, an incredible example. There are many incredible businesses that have gone bankrupt. It's not the end, it's a restructuring. So for that, where you maximize value for shareholders, or excuse me, stakeholders or creditors, or the estate is what it's called. But in a great recent example is a company called Talon Energy, which is a leading nuclear energy provider that went bankrupt in 2022 around too much debt around the time of the Russian invasion of Ukraine, when strange things happened with commodity prices, natural gas prices, and they had some poor hedges. They had a lot of debt. They didn't have a lot of liquidity. But today, as we know, power is one of the most scarce commodities that are needed desperately by data centers, and power companies are, wildly profitable and valuable. And Talon is a great example of that, with good management and a good environment, selling a valuable product. So that was a bankrupt business. There are many bankrupt companies that have really thrived over the years.
And was the equity sacrificed in the Talon bankruptcy?
So in that bankruptcy, the equity was wiped out, and the creditors, um, through rights offerings, where oftentimes what creditors do is they'll put fresh money into the company, as well as perhaps rolling or equitizing their debt. So the debt could become, or some portion of debt will become the equity of the business. Similar to, let's say, when a bank forecloses on a house, the bank takes over the equity and in exchange for its debt. So in a similar concept, that's what happened here. And usually it's at a very low or advantageous valuation. And that's really what makes bankruptcy investing, like, that's the magic. That's why I entered into it, because you're have the opportunity to invest in an area that perhaps has less focus on it by investors at potentially a very low valuation in a good business due to the distressed nature of it.
And you mentioned that the equity often disappears in a bankruptcy, but occasionally it's maintained. I'm thinking of Hertz.
That's one of the ultimate, in the Hall of Fames of bankruptcy. In the halls, there's the Hertz case, and sometimes there are other examples where there's something that can be put forth called an equity committee. So in bankruptcy, there's various different committees or groups that represent different stakeholders. There can be pensioners that have their pension potentially being impaired. There's all different types of creditors, senior creditors, junior creditors, but sometimes in certain bankruptcies, there could be an equity group, and the equity group will say, there was this one-time problem, and now the debt is trying to take the whole company and wipe us out. They're not giving us the opportunity to see the recovery in the business. And we too deserve to be able to vote on this bankruptcy case. And usually they do, but they have no representation, and their vote is just considered that they reject the case because they get zero. However, sometimes a judge or the other creditors can all agree, they could consent that there should be an equity committee where the equity holders say, we should get some recovery in this bankruptcy too, because there's value that covers all the debt as well as the equity, even if it's only a small slice. Or we being the equity, should be the ones to put in the fresh money into the company and see it rehabilitate. So, and then sometimes if they're right about their business plan that's risky, they could potentially earn incredible returns. And for a period of time, that's what happened in Hertz, where instead of being wiped out, I think the stock went from pennies to maybe over $20 a share.
Billy, is the bankruptcy process fair in your judgment?
Um, yeah, I mean, so I think that from the perspective of kind of typical debtor, typical creditor, I think the bankruptcy process is fair. I think that it has a lot of procedures in place to make sure that different parties are heard, to make sure that parties have their rights respected, to make it so that a single kind of holdout creditor who's trying to extract too much value can be overridden by the consent of a large majority. This is a situation, of course, where by definition, right, the company is kind of out of money, and so it's a zero-sum game. So it's not to say that people aren't hurt, or that kind of individual interests aren't hurt, but kind of on the whole, from a 30,000 foot perspective, I'd say generally speaking, bankruptcy is fair. That's not to say that there aren't kind of valid criticisms of it. I write about this when thinking about bankruptcy in the mass tort context. So Dov mentioned, sometimes one-time litigation liabilities can be a real um, kind of predicate for or precipitator of bankruptcy. And so that happens oftentimes in what's called a mass tort. That's when many people, say perhaps thousands or tens of thousands of people, will bring claims against the debtor for, say, putting out a product that injures lots of people. One of the quintessential examples of this kind of recently might be Johnson and Johnson's baby powder. The claim is tens of thousands of people expose themselves to cancer-causing chemicals as a result of using the Johnson and Johnson baby powder. So in those types of circumstances, I think that there are perhaps some valid criticisms about whether bankruptcy can be used to achieve what you might consider to be the non-monetary or social or even moral goals of these individual creditors. Another example might be the Boy Scouts bankruptcy, where, over a period of decades, there were allegations of sexual abuse. And so the question is, can these individuals receive the type of justice that they might deserve through a bankruptcy process that, someone like Dub is here on the call, and Larry, the kind of foundation of this discussion is, let's look at bankruptcy investing, right? That's kind of a different view on the world than how do we make sure that sexual abuse victims receive their kind of just recompense, right? So in that sense, perhaps it's a little more complicated to answer, but as a general matter, I think the bankruptcy system is pretty fair.
And can you talk about covenants and what role they play in the investing process, Dov?
Sure. So, well, taking a step back, when you look at the capital structure of a company, which is, I think one of the benefits of like looking at a distressed investment is it's a bit of like a puzzle or a strategy game. So you have to think about, yes, there could be all these different buckets of value, but that can cover the different claims in the company. So if you really zoom out, just to give a good structure of how to look at this, a company, let's say, is worth like $1 billion, and they issued a certain amount of debt as well as equity that would reasonably allow it to be operate, to support that $1 billion capital structure. But then problems happen over time, and now it's only worth 500. And perhaps some of that debt is impaired. Now, it could be worth $1 billion again. However, if there are covenants that basically say a debt to EBITDA ratio, for example, is breached, or there's a minimum liquidity covenant that is breached, that now means that the senior debt can foreclose, then the junior debt or the equity really has or the senior debt can put it into default or grab certain assets or force a sale process if these certain covenants are breached, which are, I will point out, less common today than they were in the past, but still exist. Then the company is in a very difficult situation because there's a huge cost of distress now that's being put upon the company. So even though the junior creditors or the equity can have the value supported, if the senior creditors have their covenants violated, now the company has a very significant problem and has to figure out, well, what can we do to mitigate that? Can we pay off the senior debt, and maybe the junior debt will pay them off to take them out, so the senior debt can leverage their position to get their money out of this bankruptcy and let the junior or this distress situation? Or should we file for bankruptcy, which is the point of chapter 11, is to basically put the covenants aside or to press a pause on them and allow the company to restructure and not allow the senior debt to take the assets. But all of these have a huge cost of distress, a cost of legal fees, a cost of hiring for bankers. So the covenants going into a bankruptcy could definitely be used as a very valuable strategic tool by the senior creditors to exert their pressure on junior creditors and to protect their position. Now, in the bankruptcy, there are all types of covenants that the debtor in possession lenders or the DIP lenders have, and they could set all types of milestones that must take place in terms of moving the case along, getting it out of bankruptcy, or they could typically foreclose on the business or cause themselves to be taken out. So there's endless variations of that, but the two main themes are going into a bankruptcy or a distress situation for senior creditors to kind of control the process through their covenants, and in the bankruptcy, really setting a timeline as well as certain financial goals that must be achieved, and they can also control that bankruptcy process. And that's why whoever is the DIP lender
The
in
dip is debtor in possession.
correct. So that's when a company is in bankruptcy and they need to raise. So even in bankruptcy, you need to be able to raise, um, you need to be able to raise capital. And else, how do you operate? If you have bills you need to pay, there's huge legal expenses quite often. There's tremendous financial advisor expenses. There's working capital needs. So you need to be able to borrow some money. Well, how do you do that? So the bankruptcy code allows for this super senior type of loan, which is typically a great loan to make, but comes for investors. It's at a very high rate and typically has liens on most of the value of the assets of the company, but it also comes attached with a lot of rules, restrictions, and strings attached. And so it can be very advantageous to be the person to make that loan.
And I'm assuming you've made that loan in the past.
Yes, they're typically, yes.
Billy, I'm wondering how much attention does the lawyer for the company or for the dip investor rely on the attorney to make sure the covenants are clean and they can do what they want to do?
Yeah, I mean, I would think that's a really important role for an attorney in a bankruptcy case. I think bankruptcy is, as a practice, lots of people who are thinking about going to law school, perhaps say, oh, I'm going to go to court and I'm never going to need to understand math and it's going to be great. I'm never going to have to, do any arithmetic and it's going to be just all about arguing about words. And bankruptcy is a unique practice in that it's so financially driven. And the attorneys really kind of need to not only understand the language of the debt documents, kind of what do the covenants actually say, but also have a good understanding of, given kind of the company's financial position, is this a covenant that we can live with? Is this an EBITDA ratio that we can kind of, understand, or is this going to be triggered too quickly? Is this a milestone that a dip lender is going to impose that we're going to trigger, on day 1 or day 30, and we're never even going to get to, the 6 months that we need to implement our business plan change? So in that sense, I think a lawyer's role is really important in kind of making sure that the covenants work given where the company is. And ultimately that's the role for the attorney, but of course working in concert with financial advisors and companies, internal management.
I would imagine that companies delay calling in a bankruptcy attorney as long as possible because they don't want to lose their jobs. They don't want to lose whatever equity they have in the company. Do they call bankruptcy attorneys in too late?
Yeah, so that's kind of the classic view is, and I think it's largely right. Though perhaps there have been some changes recently, that I'll mention. So the classic view is basically management doesn't want to call in a bankruptcy attorney because ultimately bankruptcy lawyers indicate to the market that a company's in trouble. The end of the bankruptcy process is generally going to involve wiping out the equity. It's generally going to involve the replacement in management, and so from the perspective of the manager, that's not what they want. The flip side to that, of course, is, Dov kind of alluded to this a little bit. It's the idea of what's known as the option value of equity. The idea that, all we need to do is make this one great new business plan change, finish our Hail Mary product, and all of a sudden the stock's going to go from 100 to 500 and, we're all going to be able to retire. So in that sense, right, and equity benefits from that, whereas debt holders, generally speaking, want to keep whatever value they have. They don't care, they get paid back the face value of their debt at best, right? So they're not happy. They don't care if the company's worth twice the face value of the debt or 20 times the face value of the debt. They don't see any of that upside. So in that sense, company and management is, or I should say companies and management are incentivized to make that bankruptcy call kind of as late as possible. I'd say the one kind of exception to this is that's for a filing of bankruptcy. But for more and more recently, companies have been negotiating kind of what you might call out of court restructurings or kind of pre bankruptcy types of restructurings. And so there, bankruptcy attorneys will get involved pretty early, and they may not be thinking about themselves. They may not have their bankruptcy hat on. They may have their kind of leverage finance hat on instead. Though, of course, I think a good bankruptcy attorney or a good leverage finance attorney is going to be thinking down the line to what might happen if the company does go finally file for Chapter 11. And the idea with these kind of out of court restructurings is that they'll be able to negotiate, some additional financing of one kind or another. Maybe there are new assets that can be lien that, a creditor could attach. Maybe there are new kind of creative strategies that they could use to get financing from some of their existing lenders rather than other existing lenders. These all fall within the broad category of what's known in the industry as LMEs, or liability management exercises, or liability management, LMEs, right? And so the idea there is they're not calling in the bankruptcy attorney because they're saying we're throwing in the towel and, running right to court, but instead they're calling in these leverage finance, attorneys who happen to be the same people often who are ultimately going to be involved in the restructuring, or at least the same firms if there is one, and they'll get involved earlier in the process. And the last thing I'll say is this whole process ultimately leads to, you alluded very briefly, Larry, to kind of the cost of bankruptcy. This is one thing that ultimately leads to a higher cost of bankruptcy, because there is a lot of kind of now pre-bankruptcy structuring that's going on from the perspective of management to avoid bankruptcy, from perhaps a more skeptical perspective to kind of, get whatever limited runway they can before filing for bankruptcy. But that just adds to the capital structure complexity, and ultimately to the professional fees that are involved in a bankruptcy filing.
That seems like a rather great conflict of interest, that the management gets to determine when they file for bankruptcy, knowing full well that in bankruptcy they're going to lose their job.
Yeah, I mean, I think that ultimately you can kind of see the conflict of interest. I think the counter argument is something like, well, we're acting in the best interests of the company, right? For the benefit, right? Their kind of fiduciary duty is to the company for the benefit of the current owners, which are at that point the stockholders, right? And so from the stockholders' perspective, they want the company to make that Hail Mary pass, because that's the thing that's going to raise their equity from pennies on the dollar to, as Dov mentioned in the Hertz case, right, $20 or whatever it was. So that's what's really actually going to restore them. So you can certainly see the conflict of interest that's there, but I think that the counter argument would be, actually, this is really just serving the interests of the equity. And if equity doesn't like it, equity, of course, can vote management out.
Yeah. Of course, from my point of view, when I'm editorializing now, they probably extend this and make the company's problems even worse.
The data appears to show that, for what it's worth. There is some limited kind of empirical data on this, and it appears to show exactly what you think.
Dov, when do you employ a bankruptcy attorney in your investment process? When do you think that you need the services of a bankruptcy counsel?
Taking a step back, we start following a case when the company is distressed, typically. So that when their debt is, whether it's yielding a very high amount, maybe trading in the 80s or the 60s or the 40s, depending on the situation. And we'll start doing the work to understand the capital structure and understand the covenants, like what you pointed out. And we'll typically use certain firms that specialize in that and will give us advice on where, on various different powers or leverage points different pieces of the capital structure have, and different boxes of value in terms of what they control or what their collateral is. Then, after a company what will typically happen is, before a company files today, there's two types of filings today typically. There's what's called the free fall filing, rare, and that's when a company literally just runs out of money. It does happen. It's usually involves some amount of fraud or some other disaster. And when that happens, it's a shock to the market. And immediately creditors kind of get together in groups. So let's just say we own some unsecured bonds. We would get together with other unsecured bonds, and we would try to hire counsel to help us. And ultimately, And what usually happens is the company or the estate will pay for those lawyers. In more organized, what typically happens in restructurings today are, and this could be in or out of court, so it doesn't necessarily have to actually use the word bankruptcy. The company or lawyers representing the company will come to various groups of creditors and say the company needs to either get relief, do a debt for equity swap, something like that. And you guys should get together, form a group, and we'll have a negotiation over a period of months. So those are I touched on three different and that will be you'll be represented by lawyers and financial advisors. So basically it could happen and we will use like smaller specialty firms when analyzing a company to begin with to as an actual restructuring takes place, whether a free fall or much more commonly a negotiated whether it's in court or out of court plan where the groups of creditors will get together, hire a large bankruptcy firm that the majority of the creditors in that group or the major ones agree on, and each group will have their own representation, each part of the capital structure, or each creditor group, and that's when we use bankruptcy lawyers.
And does each part of the capital structure also form a creditors committee? Let's say it's a creditors committee, so that you'll have a creditors committee for the senior debt, for the DIP financing, for the junior debt.
Sure. So, well, the first lien, like bank debt, they typically have their own. They don't really form necessarily a committee, but they are typically represented, and the company pays all their bills, and they are usually at least at this stage in the driver's seat, and they have like a secured creditor group. Then there's what's called the unsecured creditors committee, as well as there could be different groups, different what's called ad hoc groups that could be representing certain bonds. There could be other claims, and depending on the size, they could form their own groups. And there's a benefit to being in these ad hoc groups as opposed to serving in a bankruptcy on the official committee of unsecured creditors, because if you're on that committee, you typically get MNPI, material non-public information, and it's very treacherous, potentially like trading in the securities of the company. So forming these ad hoc groups, you could potentially limit yourself to what the type of information you receive, depending on the situation, and you could continue to invest in the company and make decisions. But sometimes you'll want to be in the unsecured creditors committee. It really depends on the situation and the length of the bankruptcy, and the type of negotiation that's going on.
Have you been on many creditors committee?
Yes, I mean almost always they're ad hoc committees, and whether it's in a bankruptcy or it's leading up to some type of restructuring in court or out of court, but it's like in the world of distressed investing where you're huddling with other investors, your own financial advisors, and your own lawyers that are advising you, and that's the common way it's really done today.
Are there often, maybe I'm asking you this, Billy, are there often deals whereby management gets certain creditors on their side and they make deals with the creditors at the expense of other creditors?
Yeah. So that kind of thing happens. I think more common is the idea that management, rather than taking it, say, at the expense, from some creditors at the expense of other creditors, usually, sometimes management will work a deal out where, they're going to be kept on in some way. They'll receive some kind of management incentive plan, or they'll, receive some portion of the equity or some rights, something like that. I think that's more common. What you're starting to see now is, and this kind of goes back to what I was talking about with LMEs, you're starting to see what are known in the industry as non-pro rata exchanges, or kind of, colloquially known as lender on lender violence. So the idea is that there'll be a group of favored creditors creditors that management wants to work with, and management will, in order to kind of, make sure it still maintains some skin in the game, it still maintains some equity, it still maintains some possibility for the upside, still keeps its jobs. Management will offer a bit of a sweetheart deal to some lenders as compared to the other lenders. And these lenders are incentivized to get on because you're kind of, either sitting at the dinner table or you're on the dinner table, you're the dinner, right? So the idea then is you'll want to be part of this non-pro rata exchange. You'll want to be part of the favored lender group and kind of involve yourself in the deal that way. Though, of course, it's very contentious, as you might imagine. And courts have I'd say largely been mixed about whether these things are acceptable or not. There are questions about whether this violates the terms of the particular bonds or credit agreements. There are questions about whether this violates more general ideas of good faith and fair dealing. But a lot. I'd say most of the time these things don't go to a judge, right? It's kind of all of this is happening in the background, and by the time the deal already happens, it's hard to unscramble that egg. It's very costly. It takes a long time. Parties just kind of move on. So it's interesting to see where the equilibrium is going to lie here. I've read reports and understand that in some ways it's getting a little less um, lender on lender violency and perhaps a little more cooperative. But I've also heard some reports to the contrary as well. Dov may have a little more to say on that, kind of in the trenches.
Uh, Billy, if there's lender on lender violence, can I assume that the covenants are at fault and that the lawyers are at fault for not protecting their clients?
You know, it's hard, right? So, these credit documents are sometimes hundreds of pages long. In a big bankruptcy, they may encompass dozens of entities. They may involve, different types of assets that are spread all around the world in different types of buckets, and companies change sometimes. So sometimes it can be seen as an oversight, but I think more common is these documents are just really complex, and there are creative individuals who are able to find what may be inadvertent loopholes in some of these documents. That's kind of the original story behind some of the first LMEs. What I think is more interesting is perhaps why some of these original things haven't been fixed in later documents. Sometimes they have, sometimes they haven't.
And can you tell our audience one more thing? What is a cram down?
Sure. Yeah. So I alluded to it a little bit earlier, right? One of the reasons why I think bankruptcy is fair at a 30,000 foot kind of perspective is the idea that rather than allowing just one holdout creditor to kind of, extract a lot of value or drive an otherwise good company kind of off the side of the mountain, a cram down is when, under certain circumstances, a judge can overrule certain dissenting creditors and allow a company to proceed with its bankruptcy plan with not unanimous support, but say supermajority support.
Dov, is there a timeline that you look at between your investment and an ultimate resolution?
Yeah. I mean, first of all, that's a key. Thinking about that is a key part of how you will think about when to purchase into a distressed opportunity. How long is this going to take? So what, and because that those, that the time period, the cost of distress is very high, as we spoke about. So there's the legal, financial advisors, all that stuff. But in addition to that, there also is the business risk that happens from being in bankruptcy or being in a restructuring or not having, liquidity that you need to fund your business and invest in R&D or whatever else you do. So the timeline, if this is the type of thing that is just totally unclear, it's not buttoned up at all, there's no plan. We'll typically think very carefully, is this something we want to get involved in? But in other cases, it could just be a few months and there could be a clear plan of what is going to occur, and usually it could work itself through the bankruptcy system pretty quickly, And that is something that we favor.
And I just add at the limit on the other side, there are bankruptcy cases that happen in 24 hours.
Oh, yeah. That's a prepackaged bankruptcy, I assume.
Definitely.
I'm going back to you, Dov. We seem to be in a period of higher interest rates. I'm wondering if there will be more opportunities than we had over the last few years because of the higher interest rates.
Absolutely. We're seeing it now, especially as the burden of interest, as well as companies facing other pressures like commodity pressures, for example, the rise in the price of oil, other commodities, other input costs. It just technology is injecting, such as AI, injecting a lot of uncertainty into businesses, and perhaps hurting their growth. So the combination of these things coming together, as well as just the burden of this ever increasing interest expense, really is sapping value away from companies in favor of creditors and making the need to restructure much more necessary.
And how does the availability of private credit alter your perceptions of bankruptcy opportunities?
So it's a really interesting question, because in the near term, what I think a lot of private credit transactions have done is really the private credit doesn't want bankruptcies. They don't want restructurings, and they are very incentivized to continue to let management or bring in new management, but let the capital structure continue and see if they can extract, at one day extract their loan, extract as much value as possible. And because private credit are typically very few parties, and sometimes it's what's called a unitranche, so they're providing the first and second lien debt. So with the stroke of a pen, they don't need any bankruptcy courts. They don't need any of this. As long as the company literally has a money to operate, there's no covenant that really matters if those few or single creditor doesn't want it to. So they could just change the document and let it continue. Now, eventually, when does that exactly mean? Maybe we're at the moment today. I don't know. But eventually, there is a time when those private credit funds need to return capital to shareholders. When there are other events that could lead to there's a need for an exit. At that point in time, you have to there could be a cascade or a much greater, a bolus, a huge increase in the number of companies that need to restructure, because all these cans that were kicked down the road. I mean, the road there's too many cans, and the intersection is full of these cans, and now there's a much greater reckoning. So that's how I would think about it.
I want to bring Gwen back on, but I want to ask you one more question. If you could go back and remember your younger self when you started this business, what piece of advice would you give your younger self as a result of all these years you've been in the bankruptcy business?
So a few things come to mind. Number one, work with good people. Even in the restructuring business, if you're going to align yourselves with other creditors an honest management, that is your first step to having a very good outcome. Two is focus on good businesses that have a one-time problem, what we're talking about. And three, good people, good businesses, and then three, understand process risk. So often, and some of our best investments over the years have been waiting until let other people, other investors, other creditors, management, advisors, they worked so hard on crafting the plan. And then there's so many investors that don't want to participate on the recovery of the business. They work, it could be banks, it could be others. They work this through and now they're ready to exit. And you could avoid so much of the process risk and just focus on the economic or business risk and invest at an incredibly attractive valuation. And this is really what attracted me to the business, as opposed to trying to always like craft the plan and be the one to go through all the brain damage to do that. So often it's better to let other people do that. And then even if you're paying a little bit of a higher price, but avoid the process risk. And so many times that has benefited investors
You let
greatly.
guys like Billy do it. Gwen,
We are actually kind of close to the hour, and I have a lot of questions here, and I want to thank the audience for posing them. But really to respect people's time in the hour, there's a question very similar to the one that you just posed, Larry, and this is to both Dov and to Billy. The question is there a book or textbook you came across during your MBA or law career that further fueled your interest in bankruptcy investment? Is there anything that you'd recommend?
Dov,
Dov
please.
first.
Uh, I'll go first. Okay. I would say one, there were two books. One was called The Vulture Investors, and the other one was called Distressed Debt Analysis by William Moyer.
So I was going to recommend the Moyer book actually as well. Distress Debt Analysis is kind of the classic in the field. There's a book called Eccentric Orbits, which is about the bankruptcy of Iridium, which was a satellite provider. And it kind of goes through the whole, or I guess a provider of satellite communications. It goes through the whole story. The last one that I'd recommend is Caesar's Palace Coup. So that's a much more recent one. That's about the shenanigans both in and out of court related to the bankruptcy of Caesars, and involves some really high-powered private equity and distressed debt firms, and lots of kind of big personalities, big egos, really interesting bankruptcy stuff, written by journalists who had some kind of real inside knowledge as well. So those would be 2 or 3 books I'd recommend.
That's very interesting. I think what we'll do is get those and maybe add those to the posting on the website for people who
Sure.
might be interested in all of them. We are close into the hour now, and I'm going to just toss it back to Larry and say, Larry, do you have any final thoughts or comments on the
yeah,
subject of distressed investing?
yeah. My suggestion is this is a field that's best left to the professionals. Amateurs should not participate in this game. This is for people like Billy and Dov who spend their lives at it. You can compete.
Sage words of wisdom. Thank you all very much. Thank you, Dov. Thank you, Larry. Thank you, Billy. We will be making an announcement about our June webinar very soon, so stay tuned. We'll announce it, of course, on the website. We look forward to seeing you all in June for a new conversation. So for now, thank you, Dov. Thank you, Billy. Thank you, Larry.
Thanks, everyone.
Take care,
Thank you.
everybody.